I'm a former IRS agent and teaching instructor with IRS. Welcome to my YouTube channel. This is the home of the 5-minute or less video. As a former IRS agent, by now I've worked around 10,000 cases. I worked at IRS for how long? Approximately 10 years. I've been in private practice for 40. I have been doing IRS tax defense. 40 years. I've been doing this a total of 50 years. If you want to see me in a suit and tie, I only get dressed up for my TV interviews. You can see them. I've been on almost every national broadcast. I've been on 10 of them probably in the last 3 months. You can see some of my videos at 777irs.com. More importantly, you can see my team of former IRS agents there. They're an awesome team that I've collected over the years, and we all work as a team. I do these videos so you don't get ripped off. I deal with you in honesty and truth, and I give you the information that you need. Today I'm going to talk about the IRS trust fund penalty. The IRS trust fund penalty is also known as the 6672 code section penalty, and it really catches up to people by shock. It really does. What people do not realize that when they open a corporation and they're running a business, if the payroll taxes aren't in fact paid, IRS can set up the trust fund penalty against them. That's the 6672 penalty. What the trust fund penalty is this, and I want to break it down for you. The money that was held in trust is the withholding and 1/2 of the Social Security tax. The other half of the Social Security tax that the corporation was supposed to match, and the penalties and interest goes away. So let me explain this so you understand this. The corporation owes the tax in full. That always goes away, but IRS makes what I call a protective assessment against the individuals responsible to pay the tax. Now, who does IRS find responsible? Well, let me ask you, who would you find responsible? IRS will look to those who signed checks, who ran a business, signed corporate resolutions, they were involved in contracts, had the right to hire or fire, and do a number of things. So those are the people IRS will go after when they try to set up the trust fund penalty. It may be one person, it may be the owner. One time at IRS, I had 10 people who ran a large company. So at the end of the day, the revenue officer goes in, has everyone fill out a 4180 interview. That's an important form to understand for the trust fund. It's something that you want to go over, you want to look at, you want to familiarize yourself with, because it helps IRS, the revenue officer, setting up the deficiency, pinpoint who is truly in charge of this and who's going to be set up for the trust fund tax. So once again, the trust fund is actual money that the company held in trust. What was the money held in trust once again? It was the withholding in 1/2 of the Social Security. IRS, for the purpose of the trust fund, does not go over the match Social Security nor the penalties and interest. They just kind of absolve it. But IRS is hoping to collect from the corporation, but they know they're going to go after the individuals. It's really interesting what happens when they set up the individual assessment. Let's say the individual assessment from the trust fund tax was $80,000. Let's say there's 5 people involved for this corporation. All 80 people, all 5 people will be set up for the $80,000. IRS then collects it from the first person they can. And when the first person pays it or can't pay it, it goes away. You may have a number of people pay it. IRS keeps up until they get their $80,000, and then the debt goes away. I've had a couple people, one person paid 80, the rest of the 4 people stayed under the radar and it went away. So at the end of the day, if you are a tax practitioner, the most important thing you can do is make sure payroll tax deposits are made, because this penalty is going to come up to the corporate officers and those responsible like a thief in the night. And the next thing they know, they're going to be strapped with a trust fund assessment. And how does IRS collect the trust fund assessment? They collect the trust fund assessment just like there was a personal tax liability. IRS will send you a series of notices, and boom, just like that, you will get set up for it. But I do need to tell you one more thing. When the revenue officer comes in and makes a determination, they will send you two forms, a 2751 that breaks out the penalty, and a letter that you can file an appeal, which is on an 1153 that you have to file that appeal in 60 days. So if you feel that you were set up illegitimately or IRS made a mistake, I suggest everyone go to appeals. Many times, all 5 people in my situation did go to appeals, and IRS found each one of them responsible. The IRS appellate agent will look at each case individually. They will see what their responsibility was to the corporation, who signed the checks. And what's really amazing about the trust fund penalty is when you go in to work these cases and you say, hey, who's responsible? Everyone points to the other person. So at the end of the day, as a practitioner, you'll want to familiarize yourself with the 4180. So if you are a client or a taxpayer hearing me right now, there's always a defense that you were not the person really in charge, and you can have a defense for that. We defend trust fund penalties every day. So the key is understanding the 4180. If you're a tax practitioner and you know there's 941s being not paid, you may want to exit the company really soon. I wish you the best of luck. If you'd give me a subscription, I'd really appreciate it. Thank you very much.